Hi, Bill Brooks, Boulder, Colorado. Wanted to go over some individual income tax planning strategies before the end of the year for 2014. Well, these will work for almost any year, but here we are, December of 2014. Well, all things being equal in terms of tax rates and income, the general wisdom is to do three things to reduce your income tax. One is to push your income into next year if you can. Second, pull your deductions into this year. And third, keep your options open as to late breaking changes in tax law. Well, here's some handful of tax planning strategies for you to consider. Harvest capital losses before year end to offset capital gains. And also up to $3,000 of ordinary income if there be no capital gains to offset. If you plan to be in a lower tax bracket in 2014, you can consider converting a traditional IRA to a Roth, basically to keep your taxable income in the 15% tax bracket. And keep in mind you can reverse that conversion as late as October 15th, 2015. Another one, consider selling real estate on the installment basis to spread the tax over at least 2 years. You can elect out of the installment method treatment when you file your 2014 return next year. Another, make charitable donations to qualified charitable organizations, subject to meeting the substantiation requirements. Remember to consider donating appreciated capital gain property you have owned longer than 1 year, and you can deduct the property's fair market value. Also, you can charge by credit card a donation and deduct it, even though you don't pay it till next year. Consider, again, bunching your medical expenses or bills into this year or next year. Keep in mind that there's a 7.5% hurdle or limitation of adjusted gross income for taxpayers 65 or over, and 10% for everyone else. That is, you have to exceed 10% of your adjusted gross income before any medical expenses count. If you're subject to the AMT tax, alternative minimum tax, and I can run a projection for you, you might postpone certain tax preference items such as medical expenses, miscellaneous itemized deductions. Not all medical expenses, subject to some tests. Taxes taken as itemized deductions, income from the exercise of incentive stock options, depletion, and others as well. So you can consider postponing certain of those events if you can. Or if you're in a higher tax bracket above 28%, this year you could accelerate income into this year. There is an investment out there called a passive income generator investment that throws off passive investment income to offset capital losses that you may have been carrying forward. Remember to keep in mind that there is a $25,000 active rental real estate loss deduction every year available. Consider taking a personal exemption for a relative, would be a child, stepchild, foster child, brother, sister, half-brother, half-sister, stepbrother, stepsister, father, mother, grandparent, stepfather, stepmother, cousin, nephew, father-in-law, mother-in-law, brother-in-law, sister-in-law, daughter-in-law. It's quite an extensive list, right? Keep in mind you have to provide over half the support for housing, food, clothing, education, medical, and dental, travel, to name a few. Also consider holding on to stocks or mutual funds for at least 61 days, and then you would qualify for the qualified dividend tax break, which would be limited to 15 or 20% if you're in a higher tax bracket versus the ordinary tax rates. So there are a few. Any questions, please give me a call, 303-447-1626.